So from time to time, I throw a poll out on Patreon and ask my beautiful channel supporters to vote on which stock they want me to review next, and I was definitely not shocked that Draftkings won this poll. This stock has mega potential and is all the rage right now, with people loving the gaming stocks and also loving to throw money away gambling, which, to be honest, I still can't get. But Draftkings themselves have really been doubling down as well on advertising, because you cannot turn on a TV to watch any sporting event these days without seeing the Draftkings logo perfectly placed somewhere. Whether you're watching UFC, you see the Draftkings logo there, or whether you're watching football, and I'm talking about the real football, not what you Americans call football, because you guys don't even really kick the ball with your feet. So why is it called football? Rant over. But this company is growing quickly in a fast-growing sector, so surely it's worth an addition to anyone's portfolio, because if you check Reddit, this company's going to the moon. But hold your horses, cowboy, put your pistol back in your holster, take a seat, take a sip of whiskey, because we're about to embark on one of the most perilous journeys the West has ever had to offer. We're gonna get butt naked in a bathtub with some fugitives from the Old West and give Draftkings its worst ever STI. So what's going on, esports fans? And yes, that is an actual thing now. In this video, we're going to talk about Draftkings, the stock, and is it a good buy, in my personal opinion. This company is all the hype right now. People are calling it a growth stock, a value stock even, and of course, it is technically a hype stock if you ask me personally. But this company is definitely going to the moon if you look on Reddit and Twitter, and to be honest, it is doing very well in terms of advertising. It's becoming a household name. Even my father, who struggles to unlock his iPhone, knows what this company is, because when he was in the pub recently talking to Gary, he seen Draftkings advertised on some sport and he thought it was a draft beer company. No, Dad, it's not. Draftkings is a fantasy sports betting company which basically allows users to play games online with each other and make bets against each other, and the winner can make money. Yes, you can actually make decent money playing sports online and becoming good at making money playing video games. Basically, that's the whole concept. But gaming and online betting have done very well over the last year and a half because people are stuck at home absolutely bored shitless because of the Miley Cyrus. So it makes sense that Draftkings have sort of tripled down on their advertising, maybe even more than triple, and I'll talk about that in a second, and become this big household name, and their revenue increases suggest that too. So given the fact that they're in a growing sector, dominating the sector, and this sector should grow as well in the future, surely it's going to the moon, we should all buy it. Well, just remember in this video, this is not financial advice. I'm just a bloke on the internet with a beard who's really struggling to get my head around all the gaming lingo I'm going to talk about in this video. If you want to support my struggles, please do make sure that like button is turned blue. It'd be greatly appreciated. And like I said, this did come from a Patreon poll, so if you want to support the channel and get some exclusive perks, check out Patreon down in the description. And if you want to get chatroom access for life, sign up with eToro on the pinned comment. Sign up, deposit, make a trade, and you get lifetime access to the LWT eToro chat room. Now, moving on to Draftkings, what the hell is this company all about? Because my older viewers are probably thinking, what the hell is esports? What the hell is e-gaming? Sports betting? It doesn't make sense. Well, let me put it in simple terms. If you had an older, drunken grandfather like I used to have, and he wasn't drunk all the time, just when he was awake, but he used to take me to betting shops, and there he'd go and place a bet on horse racing. There you would also have a little TV with some cartoon horses that would plop along, and you could make a bet on these horses. And of course, I'm pretty sure this was rigged. If you go to some beach resort and you go into these like little arcades, you might have seen the little plastic horses that, you know, run along on an arcade machine as well, and you can bet on that too. In a way, it's a little bit like that, but someone's controlling the horse. And the people controlling the horses are sat at home with a PlayStation, pressing buttons as fast as they can to try and win the race or try and win the sports game. And you can bet on these horses or these people to win the race. And of course, if they win the race, they also win money, yada, yada, yada. So I hope that really clarifies what it's all about. But again, with the Miley Cyrus, everybody been stuck at home, gaming sector absolutely booming, it makes sense that this company is going to have great revenues and, more importantly, thrive in the future. So now moving on to Draftkings itself as a stock. Draftkings started out as a SPAC stock, a special purpose acquisition. And if you don't know what a special purpose acquisition is, There's a video up here which hopefully I'm pointing to the right way. You can go and check out, and hopefully it'll explain it in a little bit more detail. But recently, all SPAC stocks have been getting absolutely battered, and Draftkings is the exception. This stock has actually gone from strength to strength over the last year or so, and it is continuing to look quite decent if you just compare it to the other SPAC stocks. Looking at the chart alone, we can see the Draftkings merger got announced in December 2019. At this time, the stock was trading around $10, which is not abnormal. Most SPACs do trade around this level until a merger is announced, and then they start rocketing to the moon because the hype is real and all this other lovely stuff. But in Draftkings' case, the hype actually was real. It went ahead and it actually got merged and turned into Draftkings itself as a company around about April 2020. At this time, the stock was trading around about $18, $19, and from then, it's still also gone from strength to strength. Reaching its all-time highs in March 2021, it reached a whopping $72. Now imagine if you just bought in at that $10 level and rode the hype train. But since then, it started to fall down and currently trading at around about $50. So there is a decent upside move if it can get back to them all-time levels. And can it get there? Well, let's have a little look at the fundamentals. At the recording of this video, Draftkings is a $19 billion market cap company. Simply Wall Street's algorithm thinks that it is a 15% overvaluation at its current price, but again, Simply Wall Street's wrong as much as it's right. But this company is not profitable. It has no PE ratio, it has no PEG ratio, so we can't look at that itself. But if we look at the financial health of the company, we can see that it has short-term $3.2 billion in assets and $638 million in liabilities. So definitely short-term assets and liabilities well covered there. And looking at their long-term assets and liabilities, we can see that they have $1.2 billion in assets with a shortfall of liabilities of $1.52 billion. So it doesn't look that good long-term because the assets and liabilities are slightly mismatched, but I want to stress, their short-term assets outweigh all of their liabilities, both long and short-term. Their debt-to-equity ratio is really good as well at 53, and I want to point out something that I don't normally point out at this point in these STI videos. Their growth is phenomenal. Their forecasted earnings growth is a whopping 39% year on year, which is a mega wow, but I do want to point out at that point as well, it's still at this growth rate estimated to take 3 years for this company to turn over a profit at the current rate. How is that even possible? Now, the most important thing that we look at here is the insider buying and selling. And like I said, it is a ex-SPAC stock, so you have to sort of take this into consideration. Around about 9 to 12 months ago, there was a whopping 22 million shares sold on this company. But again, that's probably just people getting out when the merger is done. And since then, there hasn't really been any selling. But a key point here is really there hasn't been any buying either, which leaves me with a bitter taste in my mouth because it sort of does scream dilution at some point in the future. I mean, why are the insiders not buying this company when it's fell from 72 down to 50? Or even after the merger was complete, why wasn't anyone buying this company on the way up? Probably because it's not profitable. If we look on tip ranks, there's 13 top analysts who are looking at it. 10 people are saying buy, 3 people saying hold, and 0 people say you should sell this company. They have an average 12-month price target of a whopping $66.46, which would represent a 34% upside if they are proven to be right. And again, analysts, well, they're wrong as much as they're right. But so far, it is actually looking quite good. They've got good debt to equity, they've got good assets and liabilities, and the company is growing fast. So in 3 years, if they are profitable, surely this company is going to go from strength to strength. They're in a fast-moving sector and clearly dominating it. So at this point, you're probably asking yourself, look, LWT, what the hell is the catch? And I'm going to tell you right now, if we look into their earnings, there is something that really concerns me. If we look at their annual revenues from 2017, their annual revenue was around about $119 million US. And then we equate that to last year, 2020. We know that everybody was locked inside in this year, so we have to take that into consideration. But still, nonetheless, the company grew its revenue by a whopping amount. Its revenues went in 3 years from $119 million to $614 million. That's massive growth, 3.2 times growth in 3 years. But the big problem I have here is if their revenues went up 3.2 times, they're still not profitable. Why? If we look at their expenses, it's a bad picture. In 2017, their expenses were $233 million US. And again, if we look at 2020, their expenses went up to $1.111 billion US. Now that is mega growth in itself. How is this company growing at the rate it is and its expenses are growing even faster? Because from 2017 to 2020, it grew by 4.7 times. So its expenses grew 4.7 times in this period, but their revenues only grew by 3.2. How is this? Why? Well, the simple answer is marketing. They literally are dominating marketing. They've took the Red Bull marketing approach and basically nuked it, turned it into Doomsday. If you watch Superman or Smallville, you know what Doomsday is. Bit of a geeking out session there. But if you know what that is, then basically they've just took this idea and exploded it and times it by 1 billion. Well, literally 1.1 billion. But they are really dominating on marketing and they are getting their name out. Like I said, they are becoming a household name, and that is the whole focus and goal. I think it is quite clever from them because they realized everybody sat at home and not many people knew about it during this whole Miley Cyrus. Now people know about it, and their aim is clearly to keep this whole consumer base and then grow from strength to strength. So right now for me, if I'm being completely honest, I am watching this company very closely, but I don't think I'm going to buy it in the next year or two because I really need to see their operating expenses come down and see if they can keep this revenue level. Now I understand they need to spend money to bring in customers to make the money, but as it stands, they're losing more money faster in marketing than they are from gaining in revenue. I want to see if this company can stand on its own 2 feet a little bit and decrease that marketing budget while still keeping some decent revenue and hopefully turn over a profit. Now, I do think this company will do well in the future, and I do think it will become a much bigger company as they are allowed to be operating in more and more states and people can gamble away freely. But right now for me, being a value investor, I just don't think it's a good enough buy for me. I think there's better opportunities out there. And if we look at their market cap, and this is where it's sort of really confirmed it for me, their market cap is $19 billion US. They've never turned over a profit, and they're spending a lot of money on marketing to become a name that people know and love. Now, a $19 billion US company should have revenues in the region of $2 billion US. Again, a very rough calculation there, but their revenues are only $600 million US. So for me, this $600 million US has to come up to the 2 billion mark to even really have a chance of justifying a $19 billion US market cap. And I know some people are probably going to be commenting away right now in their heads on Twitter or even angry on Reddit at me saying, yes, but they will have 2 billion revenues one day. And I agree, they probably will. But that right now is priced into the stock price. So where is the growth? If this company goes from 600 million to 2 billion, I expect the stock price to go even higher as well, which just shows this crazy market we're in where things are really overvalued and you have to be very careful when it comes to picking stocks. I have no doubt this company will run in the future and I am just not going to be part of it. I'm a value investor, I like my safer stocks and I like buying value. That said, if this company came all the way down to maybe $10, $12, and I think it will potentially, if they dilute to raise money to help basically fund their marketing addiction, then this company does become interesting. It doesn't mean I'm going to buy it, but if you want to know when I'm buying it, you need to sign up on Patreon. We've got a WhatsApp group and you get to see my portfolio every single week, even with the basic tier. So to summarize, I think the concept and the company will do very well in the future. I just think right now it's not good value, thus it's not for me. But I'd love to know your thoughts in the comments. Do you think it's a buy or a sell? The code word for this video is FIFA. If you don't know what FIFA is, Google is your friend, and I'll see you in the next one. Take care. Peace.